New rental units are sitting empty near universities. Here's the numbers that explain it. Welcome back, Smarties, to Smart Real Estate. I'm Addy Saeed.
And I'm Ribhu Rampersad. Addy, today's episode has a tension running through it that I think every investor needs to sit with.
It does. We got Ontario posting its slowest growth year on record outside of a severe recession. That's the headline. But at the same time, landlords with the right kind of assets are still winning.
Same week, two completely different stories. New rental zones going up in Mississauga and new rental buildings near universities sitting empty.
Both true. We're going to be spending most of today's episode on that paradox. What's actually happening with vacancy, what RBC's latest data tells us about rates and the broader economy, and then we'll move into regulatory and deal flow stories rounding out the week.
There's three themes today. One, the vacancy paradox. Why new supply doesn't automatically solve the housing shortage. Two, what the resale rebound and the rate environment mean for your underwriting. And three, where capital is actually deploying right now and what that tells us about conviction.
So let's start with the number in our cold open. Canada doesn't have enough student housing, and the new student housing that is being built is sitting vacant.
Sounds like a contradiction.
It does, but it isn't. CMHC's mid-year data confirms it directly. High vacancy is concentrated in post-2020 builds and in units near post-secondary institutions, not older stock, new stock.
Let's put real numbers on it. A National Student Housing Summit this month cited research showing 7 to 9% of Canadian students consider themselves unhoused. They don't know where they're sleeping the next night.
And over 1 million students in Canada are living at home and commuting to universities, specifically for financial reasons. That's not a small input, that's a structural signal.
So the demand is there, but the willingness to pay at the rent levels new construction requires isn't.
This is the investor math, and this is part I want every smarty to actually internalize. You cannot build affordable housing at today's construction costs, full stop.
Walk through that.
So a new build has to underwrite to today's land cost, today's construction cost, today's financing cost. That forces rents to levels most tenants, students, or otherwise simply can't pay. So units sit empty even while the broader market is undersupplied.
Meanwhile, an older building, bought way below replacement cost,
Stays full because the math works at a lower rent. The owner's basis is low enough that today's achievable rent is still cash flowing.
one executive at the Student Housing Summit made a related point. Scale and affordability are linked. Bigger institutional players can drive efficiency that smaller developments just can't. But he also said scale with the wrong product in the wrong market is, in his words, a disaster.
That's the bear case embedded right in this thesis. Scale doesn't fix affordability on its own. If you scale the wrong product, you've just got a bigger vacancy problem. So a couple of takeaways. CMHC confirms vacancy is concentrated in post-2020 builds and student-adjacent units, not older stock. The storage and the vacancy are the same root cause, an affordability gap between construction costs and what tenants can pay. Older buildings acquired below replacement costs remain the structurally advantaged position in this environment. Something worth watching, whether public-private partnerships between universities and private capital can actually close the affordability gap or whether that remains theoretical.
RBC dropped their housing report yesterday, and Ontario is the headline. Resales are up 5.5% nationally month over month, the biggest jump in a year and a half. But Ontario alone was up 8.8%.
So Toronto, Mississauga, York region, all double-digit gains. Even Hamilton, Burlington, Niagara, Kitchener-Waterloo moved higher, though more modestly.
So RBC points to three drivers: labor market improving in the GTA specifically, the new home HST rebate passing, and easing US tariffs.
New listings actually dipped about 1%. That tightened the sale to new listing ratio to 49.2%, the tightest it's been all year.
Now here's the part that doesn't get the same headline treatment. Prices are still down 4.1% year over year nationally. Toronto is down 6.7%, and condos specifically are down 6.5%. With Kitchener-Waterloo, Toronto, and Niagara region named directly as some of the weakest.
This connects straight back to what we just covered. The condo weakness in KWC and Niagara is the same investor-owned unit dynamic we flagged from CMHC data. Units that couldn't sell are leaking into the rental pool, competing with purpose-built rentals, and now seeing the same pressure show up in condo resale.
And RBC themselves are hedging on how durable this rebound is. Their own language, spring gains remain fragile. Their base case assumes labor markets hold and tariffs keep easing, and if those reverse, the slowdown gets prolonged, not resolved.
That's the bear case, clearly stated by RBC's own economists, not something we're inferring. One good month of resale data is a data point. It's not a trend. So key takeaways: Ontario led the national resale rebound at 8.8% month over month, outperforming most other provinces. Condo prices remain the weakest segment nationally, with KWC, Toronto, and Niagara region specifically named by RBC. And RBC explicitly frames this rebound as fragile, contingent on labor markets and tariffs holding steady. Something worth watching when June and July resale data confirms this is a trend or whether it reverts towards the slower pace seen earlier in this spring. So RBC's broader macro call landed this week too, and the Ontario number is stark. We're projecting a 0.4% growth for Ontario in 2026.
That's the slowest year on record outside of a severe recession, and RBC said that explicitly.
And they named real estate directly as part of the drag on growth, not adjacent to it, a contributor to it.
There's a few things stacking on top of each other here. Trade tensions hitting manufacturing and investment hardest in South Central and Southwestern Ontario. Population on track to actually shrink this year, and consumer spending facing headwinds from higher gas prices.
But there's a nuance worth sitting with. Per capita GDP is holding up better than headline growth because the population denominator is shrinking too. RBC's language was that the conditions could feel less strained than the top line numbers suggest.
On the financing side, RBC doesn't expect the Bank of Canada to hike in response to the recent oil price shock. Core inflation is already trending lower, and the spike from the Strait of Hormuz disruption is already unwinding.
So what's their current call on timing?
The gradual rate hikes pushed to 2027, and even that's contingent on the economic backdrop actually improving first. Meanwhile, both federal and provincial governments are ramping up deficit spending, though RBC says most of that growth benefit lands in 2027 and beyond.
So here's how I'd frame this for anyone listening who's sitting on a refinancing or acquisition decision. The headline growth number looks weak, but rate stability through the rest of 2026 is a real, usable window. RBC isn't hedging on that part.
And from the financing side, that's exactly what I'm seeing. Lenders aren't panicking. They're underwriting to a stable rate environment for the next several quarters. The risk isn't rates moving against you in 2026, but it's complacency about 2027 once that pivot conversation starts.
And the bear case is straightforward. If trade tensions or oil prices intensify instead of easing, that 2027 pivot could be pulled forward and the runway shortens. So a couple of takeaways again. Ontario's 2026 growth forecast of 0.4% is the slowest on record outside of a severe recession, with real estate named as the contributing drag. Per capita GDP is performing better than the headline number due to population contraction. Read both figures, not just one. And RBC does not expect a Bank of Canada rate hike in 2026. Gradual hikes are pushed to 2027 contingent on economic improvement. Something worth watching. Whether deficit spending from federal and provincial governments start showing up in growth data before 2027, as RBC suggests it might. If you're not already part of Smart Real Estate Community, learninvestmanage.com is where you sign up for free and get an invite to our school community to connect with other investors. So 2 regulatory stories this week, both worth knowing if you operate in the province. First, Guelph City Council unanimously passed 3 tenant protection measures: a vacant home tax, a renovation bylaw, and the framework for a rental replacement bylaw coming in July. The vacant home tax is 4% of the assessed value annually if a unit sits empty more than 183 days. The renovation bylaw requires landlords to apply for a rental renovation license within 7 days of issuing an N13. The legal clinic tracking this data said N13s are up 245% since 2020. That's the pressure that drove council to act.
And it wasn't unanimous in spirit. Local landlords pushed back hard at the meeting. One said this pushes him towards selling outright. The Realtor Association representing the area warned about deferred maintenance and declining rental stock quality long term.
Both outcomes are real possibilities and worth tracking over the next year. The second story, RECO is rolling out new brokerage financial filing regime starting October 1st, 2026. Every brokerage in the province, about 3,800 of them, will have to submit annual financial filing covering trust assets, liabilities, and compliance attestations.
This is a direct response to the iPro matter, right? The $10 million failure.
Exactly. Over 500 consumer claims came out of that. RECO's filing regime is meant to catch problems before they become the next iPro, not after. Monthly trust reconciliations reporting follow in 2027. If you're a licensed professional in the province, and I am, this is worth understanding well before October, not scrambling in September. So a couple of takeaways. Guelph's 3 tenant protection bylaws take effect this summer, with landlords pushback already signaling possible supply-side consequences. And RECO's new brokerage filing regime begins October 1st, directly tied to rebuilding consumer confidence after the iPro fiasco. Let's close on where institutional capital is actually putting money to work, because this is the counterweight to everything we just covered. Starlight Investment filed for 698 new rental units in Mississauga. 2 35-story towers directly across from Mississauga Hospital, currently being renovated and rebuilt right on her Ontario Street.
What's notable about the site itself?
It's an infill, not a teardown. The existing 12 and 13-story rental buildings on the property stay in place. And the unit mix isn't just studios chasing maximum density. 203 2-bedrooms, 73 bedrooms. That's real family size inventory sitting right on the future LRT line.
And it's not isolated. There are several other towers proposed nearby, plus the hospital expansion already under construction.
Absolutely. This corner of Mississauga is becoming a genuine rental density node. Now, separately, Hugo Bizarri from Hazelview just won a Lifetime Achievement Award. 30 years in the business, 34,000 units, $11.2 billion in assets. His read on the market right now is worth hearing, even though it's his opinion and it's not data release.
What's his core argument?
That even in the most rental construction we've seen in decades, Canada is still undersupplied once you account for the slowdown in condo construction. He also flagged something I think is underappreciated. People in neighborhoods like Rosedale and Forest Hill selling their homes by choice to rent instead, not out of necessity, but flexibility.
If that's a real structural shift and a not one-off observation, that changes who your actual tenant pool looks like going forward.
Agreed. So a couple of takeaways on this one. Starlight 698 unit Mississauga proposal reflects continued institutional conviction in transit adjacent purpose-built rental with genuine family size unit mix. Also, Hazelview's Hugo argues combined condo and rental supply remains undersupplied. His view, not a cited statistic. A potential shift towards voluntary, lifestyle-driven renting among higher-income households is worth monitoring as a demand-side signal. So let's put it all together. 3 themes today. Theme number 1, the vacancy paradox. New construction and high vacancy can coexist when the real constraint is affordability, not supply. Theme number 2, resilient but fragile. Ontario's resale rebound and rate stability are real, but RBC themselves call it fragile. Plan for both directions. And theme number 3, conviction is still developing. Institutional capital is still building transit-adjacent, purpose-built rentals, and experienced operators will see the broader market as undersupplied.
If there is one thing I'd want every smarty to walk away with, the headline numbers this week look contradictory. Slowest growth in decades, vacancy near universities, and yet towers are still going up in Mississauga. None of that is actually contradictory once you understand affordability is a variable connecting all of it.
Well said. And that's the news, and that's the analysis, Smarties. Everything we covered today and the tools to underwrite it yourself are free at learninvestmanage.com. Sign up, and you'll get an invite to our school community to connect with other Ontario investors as well. Addy Saeed is a licensed real estate broker with Remax Gold Realty, RECO license 4735346, founder and general manager of Westcliff Living, and an OSC registered dealing representative. Ribhu Rampersad is a licensed mortgage agent, Level 2 with BLD Financials DLC license 12360. The host may reference companies or entities in which they hold ownership or financial interest, including Westcliff Asset Management, Westcliff Living, Olympus Properties Group, and Finalize LLP. Listeners should be aware of these relationships when evaluating any commentary in this episode.
This podcast is for informational and educational purposes only. Nothing in this episode constitutes financial, legal, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professionals before making any investment decision. Past performance is not indicative of future results.
Hi, Smarties.